Let's get started. Where do you begin? Well, this lesson gives you insights into how to spot the property hotspots. How do you find out whether or not a suburb XYZ suburb is actually going to go up in the next 12 months? Where do you start looking? Because if you want to get into property development, you might as well enjoy capital growth as part of it. So this is where we start. Capital growth potential. Why do we buy property? Well, the simple answer is this is the only thing that actually makes you money while you're sleeping because it goes up in value over time. And capital growth is the most important vehicle for wealth generation. You need capital growth to add more properties in your portfolio. You need more equity. It's the only way to build wealth, well, as I said earlier, while sleeping. It doesn't matter if you are looking to invest in a property or looking for a deal, the aim of your development has to be to find suburbs with growth potential. You wouldn't want to buy into a suburb or get into a property development deal when the suburb is actually right at the top of it, at the peak of it, and you say, yeah, I'm gonna miss the boat, and you get in, you pay too much for land, and before by the time your development turns around, it's too late, or you actually pay too much for the land, or the cycle's gone down. So you got to make sure that the cycle's actually in recovery or towards boom, but not in boom when you wanna select the suburb. So long-term capital growth keeps your portfolio growing, and even when your project's actually over, because most developers when they actually get into property development, they if you sell everything, you pay a lot of tax. If you hold on to them for long term, you don't pay, you avoid paying all that tax, but you actually start generating all this equity in your properties. So and there are different ways to actually manufacture equity. You can do renovation and stuff, but property development, in my view, is the only strategy that actually helps you manufacture equity irrespective of market conditions. Because a deal's a deal. If it stacks up, it stacks up. It doesn't matter where it is, what suburb is it in, but it stacks up, it stacks up. The reason I put the emphasis on the suburb is because yes, it stacks up, but if you want to hold it for a long term, you want to make sure that there is some growth left in that suburb. It's not actually right at the peak of it. Every time you actually want to buy a property for development purposes or for investment purposes, make sure that you actually buy it either at the median value of that suburb or below the median value of that suburb, and I'll explain you why. But let's look at price floor and price ceiling. Price floor is actually the most cheapest price, the bottom price property in a suburb, and price ceiling is basically the most expensive property in a suburb. And you always buy below the median house price, and the reason is that your wealth is actually determined by your bank's future valuation of your portfolio, and banks only value it at distress selling. They want if they ever wanted to get it, if they ever got into a situation where they had to sell the property, they've got to go with the lowest possible price and the quickest turnaround. So if you actually buy it above that, and I'll show that to you in the next example. Well, actually, let's go to the next example. Let's look at this example here. 250,000 is the price floor of a suburb, of an XYZ suburb, and $1 million is the price ceiling. So the maximum that you can, the most expensive property in a suburb is $1 million, and the cheapest one is 250,000. So the median value is sitting somewhere at 500,000. Now suppose you wanted to buy a property for 600,000. You go to the bank for a loan, and the bank says, no, we can only value it at 550,000. What you've just done is actually you've just lost 50,000 in valuation. You've just lost almost 50,000 in equity, because later on, even if you wanted to hold it for long term, every time you'll go back to the bank's gonna say, oh no, we can only value it for 550,000 rather than 600,000. So you've actually paid for that equity, but you've actually not got worth of it. And that's why buying at median value or below median value is advisable from a long-term perspective.